Have you ever looked at your portfolio and wondered, what if? What if something totally unexpected happens? You know, an event that nobody, and I mean nobody, saw coming. Well, today we're going to talk about a pretty radical idea. Not just how to survive that kind of market chaos, but how to actually build a portfolio that's designed to thrive on it. We are diving deep into the Black Swan hedge.
All right, so here's our roadmap. First, we'll break down the Black Swan problem and why modern portfolios can be so brittle. Then, we're going to flip the script and talk about being anti-fragile instead of just fragile. After that, we'll get into the nuts and bolts with two killer strategies, the barbell and the tactical hedge. And we'll wrap it all up by talking about a whole new way to think about what it means to win in this crazy, uncertain world.
So let's start right at the beginning with the core issue. Because, a lot of the investing rules we're taught, the ones that are supposed to keep us safe, well, it turns out they might be the very things setting us up for a huge, catastrophic failure.
I want you to really think about this question for a second. We build our financial plans, our retirement goals, all based on history, right? We look at averages and past performance, and we just kind of assume the future is going to be a repeat of the past. But what if it's not? What happens when a real surprise, a true curveball, comes flying at us?
This is where we run into a huge trap. The word diversification gets thrown around like it's some magic shield. But here's the dirty secret. A lot of what people call diversification is what Nassim Taleb calls diversification. It's like thinking you're safe because you own 10 different tech stocks. But when a tech bubble bursts, they all go down together. In a real panic, all these supposedly different assets suddenly start acting the same. They all dive at once. And that safety net you thought you had, it's gone right when you need it most.
And these world-shaking, portfolio-crushing surprises? Well, they have a name, the Black Swan. This term, popularized by Nassim Nicholas Taleb, describes that event that comes completely out of left field and just changes the game. It's not a normal market dip. It's something nobody, and I mean nobody's computer model was ready for.
And look, this isn't just some abstract theory. This is real life. Think about it. Back before 1987, no one thought the market could drop over 22% in a single day. Impossible. Before 2008, the idea that the entire global financial system could be on the brink of collapse? Unthinkable. And yet, they happened. And you know what the funniest part is? After the dust settles, everyone comes out of the woodwork saying, oh yeah, the signs were there all along. That is classic Black Swan psychology in action.
And this gets to the absolute core of the problem. Our financial models are built on what's happened before. We spend all our time studying white swans, thousands of them, and we build our entire worldview on the idea that all swans are white. But here's the thing, that one single black swan that comes along instantly shatters that entire theory. Relying only on the past to predict the future is like trying to drive down a highway by only looking in your rearview mirror. It works, right up until it doesn't.
So, if we accept that we just can't predict these massive events, what do? Well, we have to change the game entirely. We stop trying to be brilliant predictors and start trying to become unbreakable. Or, even better, we learn how to get stronger from the chaos.
Okay, this is such a powerful idea. Think about how things react to stress. Fragile things, like a teacup, just shatter. They're gone. Robust things, like a steel bar, can take a hit, they resist, but they don't really change. But then there's anti-fragile. This is the magic category. Anti-fragile things actually feed on chaos and disorder. The best analogy is the mythical Hydra. You cut off one head, and two grow back in its place. The attack literally makes it stronger. That's the goal for our portfolio. We don't want to just survive a crash. We want to be positioned to come out the other side stronger than ever. This quote from Taleb absolutely nails the entire philosophy. It's about setting up your investments so they have what's called an asymmetrical risk profile. What does that mean? It means you're okay with taking a bunch of small, predictable, totally manageable little losses. Think of them like paying for insurance. Why? Because in exchange, you get exposure to these massive, explosive home run wins if and when chaos hits. You're trading a tiny, controlled bleed for a shot at a life-altering gain.
Okay, so that all sounds great in theory, but how do we actually do it? How do we build one of these anti-fragile portfolios? Well, the first big strategy is probably the most famous one. It's called the barbell strategy, and it's going to force you to completely rethink how you allocate your money.
Just picture a weightlifter's barbell, right? All the heavy weights are loaded onto the two absolute extremes, and the bar in the middle is empty. That's the mental image for your portfolio. You're going to put the vast majority of your money, let's say 90%, into things that are mind-numbingly safe.
And then you take that small leftover piece, just 10%, and you go wild with it. You put it in the riskiest, most speculative, highest potential reward bets you can possibly find.
Let's really break this down. That big 90% chunk, that's your fortress. It goes into stuff like treasury bills or literally just cash sitting in the bank. The goal here isn't to make money. The goal is to absolutely positively not lose a single penny. It's pure capital preservation. Now that other 10%, that's your moonshot fund. This is where you swing for the fences with things like options, venture capital, or super speculative stocks. You're looking for bets that could return 10, 50, even 100 times your money. The beauty is, the absolute most you can lose is that 10%, but your potential gain, it's literally unlimited.
So what you've done is you've created what's called a convex payoff structure. Don't worry about the jargon, it's a simple idea. Your downside is known and it's capped, while your upside is unknown and totally uncapped. And notice what's missing? The middle. There are no medium-risk investments here. No blue-chip stocks, no corporate bonds. Why? Because Taleb argues that's where the hidden dangers are. That's where you get the illusion of safety, but you're actually exposed to unpredictable risks. With the barbell, you've protected yourself from the bad surprises, but you're completely open to the good ones.
Now, okay, I get it. The barbell is a huge, radical shift. It means selling almost everything and starting from scratch. So what if you're not ready for that? Well, good news. There's another way to apply these same principles. Instead of tearing down your whole portfolio, you can just add a few layers of chaos insurance on top of what you already have. This is where tactical hedging comes in.
Hedging sounds like a super complicated Wall Street term, but it's an idea you use all the time. Your car insurance, that's a hedge. You pay a small, known amount every month to protect yourself from the massive, unknown cost of a huge accident. It's the exact same logic in investing. You make a specific investment that's designed to go up when your main investments go down.
So let's pop open the toolbox. First up, you have inverse ETFs. These are pretty straightforward. They're basically the mirror image of a market index. If the S&P 500 drops 1%, the inverse ETF is designed to go up 1%. Easy. Second, you can basically invest in fear itself with things called volatility instruments. These are built to skyrocket when panic hits the market. And third, and this is a bit more advanced, you can use options. For example, buying something called a put option on a stock you own is just like buying an insurance policy. You pay a little bit of money up front, and in return, you get the right to sell your stock at a guaranteed price, no matter how low it crashes.
And this brings us to Taleb's second big approach. Instead of the barbell, you just keep the portfolio of stocks you already believe in, but you build an ironclad floor underneath it. You decide ahead of time, what's the absolute maximum I'm willing to lose? Let's say it's 15%. Then you use these tools, like options, to insure yourself against any loss bigger than that. So once again, what have you done? You've capped your downside, you've limited your risk, but your upside is still totally unlimited. You can't get wiped out, but you can still hit that massive home run.
All right, for this last part, let's zoom out. Because adopting this philosophy, it's not just about changing what's in your brokerage account. It's about changing how you even define success as an investor. It means throwing out the old scorecard and creating a new one.
The source material poses this brilliant question. Would you rather be the world's greatest lover, but have everyone on Earth think you're the absolute worst? Or would you rather be the world's worst lover, but have everyone think you're the greatest? If you pick the first one, you're guided by an inner scorecard. And in investing, that means you stick to your resilient strategy even when it looks boring, even when everyone else is getting rich chasing the hot trend. You know you're playing a different game, the long game of survival and opportunity.
This classic line from Warren Buffett just perfectly captures how markets work. The wise investor buys their insurance when the sun is shining. They prepare for risk when everything looks great. The fool waits until the house is already on fire to start shopping for a fire extinguisher. By setting up your portfolio for chaos from the start, you avoid being part of that panicked herd that's forced to sell at the absolute worst possible time. And this right here, this might be the single biggest mental shift of them all. Most investors, they play a game of probability. They want to be right often. They're trying to hit singles and doubles, getting a high batting average. The Black Swan investor plays a game of expectation. They couldn't care less about their batting average. They are perfectly fine striking out 99 times in a row, losing a tiny, controlled amount each time. As long as that one time they connect with the ball, it's a grand slam that clears the bases and wins the whole game. It's a complete reversal of what most people think the goal is.
And so that's the final question I want to leave you with. In a world that we know is full of massive, unpredictable events, which game really makes more sense? Are you building a portfolio to try and win a little bit most of the time?
Or are you building a portfolio designed to survive anything and to win big when it matters the most? Your answer to that question really will define your entire future as an investor.